I believe that the purchasing power of the United States dollar over the next 10 or 15 years will fall by 75% again. And I think that as a consequence of that, at least in nominal terms, the gold price will do substantially better than most people believe.
So, okay, so you probably know Dr. Judy Shelton personally. I've got a question here. Is Trump potentially backing the U.S. into a gold standard of some sort where he will use a gold back asset like a 50-year bond held outside the U.S. Treasury that Dr. Judy Shelton has been talking about, basically to entice overseas investment in the U.S.? He's also been speaking to this golden age that he's going to lead the U.S. into. What do you think about this golden age comment, about Dr. Judy Shelton's comments about this 50-year bond backed by something, potentially with gold in it? What do you think is going on there?
I don't know if fiction or fantasy describes it better. People get into politics because they're interested in power. Having a gold backed, not denominated, by the way, lots of people have tried that fraud, but gold backed instrument imposes financial discipline. It reduces your power. The idea that anybody would subject themselves to what Mr. Trump has subjected himself and his family to for the last 12 years in order to have their power reduced is silly. I mean, it's just silly. The idea that any country in the world would shackle their ability to spend and counterfeit to the tether of gold is a complete non-starter. How many Congress people do you know have suggested that their goal in being in Congress is to have less power?
That would be zero.
How many voters do you know who would vote for a congressperson who says, I promise to leave you alone and give you nothing? I mean, this is all fantasy. It sells newsletters and stuff like that, but it's all fantasy. They exist to steal from some constituencies in favor of other constituencies. And the easiest constituency to steal from is that constituency which hasn't been born yet. So you spend today and you leave the bills for those who will follow.
That's a sad reality. Rick, interestingly, despite record high gold prices, it remains on the periphery of mainstream investment. Institutional investors largely ignore it, and insiders within the gold mining sector have sold shares instead of hoarding them. John Hathaway of Sprott, he said recently there's been minor net outflows, as in minor, and it suggests that even seasoned gold investors remain cautious. It seems that even the staunchest supporters of real money, they're hesitating to speculate on gold despite the run-up that it's had. Can you speak into that for us?
Sure. First of all, the overall observation is very, very, very true. When gold has generated returns in excess of the S&P 500 returns, when gold has gained 8% compounded for 24 years, the fact that it hasn't generated interest is, if nothing else, amusing to me. I like numbers. So here's some numbers. The market share of precious metals and precious metals related securities relative to other savings and investment asset classes in the United States is less than 0.5%. It is as important to financial markets too as like a pimple would be on an elephant's behind. It just doesn't matter. The 4-decade mean market share is 2%. If interest in gold and precious metals would merely return to 4-decade means, demand would quadruple. And I think that's what's going to happen. I'm old enough to remember the beginning of the decade of the 70s. In 1969, despite the fact that gold was a four-letter word, most people couldn't spell it. By 1980, it was on the front of newspapers. I'm not saying that it will return into the same favor that it enjoyed at the end of the decade of the 1970s, but I have absolute faith that it'll return to favor. Listen, we talked earlier about the debt of the U.S. government and the fact that it's unserviceable. In the 1970s, we dealt with that because we inflated away the purchasing power of the U.S. dollars. Over 10 years, according to the Internal Revenue Service, the purchasing power of the U.S. dollar declined by 75%. That's what we're going to do this time. Some old codger, Rick Rule, who gets Social Security, I don't know what the nominal promises they made me, $4,000, some number like that per month. In 10 years, I'll still get that nominal number. They'll honor the nominal value. But $4,000 will buy me $1,000 worth of 2024 goods and services. That same decade, where the purchasing power of the U.S. dollar declined by 75%, the gold price went from an admittedly price-controlled $35 to $850. So let's throw off the front end of that. Let's say that gold went from $35 to $100 simply because ownership became legalized again. It became unprice controlled. Then you look at the fact that gold went from 100 to 850, eightfold increase during a period of time when the purchasing power of the U.S. dollar declined by 75%. I believe that the purchasing power of the United States dollar over the next 115 years will fall by 75% again. And I think that as a consequence of that, at least in nominal terms, the gold price will do substantially better than most people believe.
So in the 70s and the early 2000s, during those two bull runs, the all-in sustaining costs for the miners took off. It was really high.
Yep.
And because of all the inflation and everything that was going on. Yet, in both instances, the miners outdid the S&P 500. Do you think that we're setting up during this inflationary period that you're talking about something similar happening?
Yes. I think beta, as I define it, which is the outperformance of a sector relative to the broad market, will favor the gold miners. A minor point on your all-in sustaining costs, one of the things that you have to look at is that during periods of low gold prices, a poorly kept secret, the mining companies high graded. If you look at the variance between the mined grade and the average reserve grade in periods of low gold prices, the major mining companies picked the eyes out of their gold deposits. So when the price went up, they were mining lower grade material for the same costs. Hence, the AISC went up for reasons that, yes, included input inflation, but they had a lot to do with atoning for past sins. And I think you're seeing precisely that occur at places like Barrick and Newmont.
I do have a question about Barrick and Newmont coming up, but I just want to stay on this for one moment. So do you see this time around all-in sustaining costs behaving differently or behaving similarly for different reasons because of the lack of CapEx and whatnot?
I do. I think what's better this time is that the institutional investor, those few that are left, are maintaining better discipline in the mining companies. If people study the decade 2000 to 2010, wonderful bull market for gold stocks, one thing they'll learn is that the free cash flow per share in the mining industry during a period in time when the gold price went from $253 to $1,700, the free cash flow per share declined. I mean, it took real skill to perform that poorly. Almost without exception, the executives who were responsible for that performance have been thanked and excused. And I think that there is a better focus in the industry as a whole on financial performance. That doesn't mean that we won't continue to experience inflation in input costs, energy, skilled labor, especially tax, royalty, and off concession social expenditure. But I think that you will see fewer companies build marginal mines. I think you'll see fewer companies take over other companies at 3 times net asset value. In other words, I think that the financial discipline, at least for the next 3 or 4 years, will be such that most of the surprises in the gold mining industry are to the upside. But one of the things I notice now when I listen to quarterly conference calls, which I do a lot, is this focus, not just by Agnico and Franco-Nevada, the leaders, but by many companies on saying the hurdle for investment decisions is it accretive on a per share basis relative to buying back our own shares? That's a wonderful metric. There used to be growth for growth's sake. And if you acknowledge that you don't have very many investment opportunities in front of you, and the consequence of that is that the most accretive thing for you to do is use your free cash flow to cannibalize yourself, buy back your own shares, and increase the relevant metric per share, that's a very good discipline.
Absolutely. All right, so you brought up Newmont. Newmont reported their numbers a few weeks back, and while revenues were up big and profits were their highest in 5 years, the stock got whacked. It was a huge disappointment. Barrick has missed production targets, has revealed higher operational costs, and has political turbulence in Africa and Asia. Investors are sour on them. In your analysis, what is going on there, and what is the health of the miners moving forward?
I'm wondering, first of all, how well the condominium in northern Nevada is working, operated by both companies. I had hoped to see better operating numbers out of northern Nevada than I have for either company. And I don't know the answer as to why yet. I will say with regards to Barrick that it hasn't been focused on growth. It's been focused on strengthening its balance sheet, which it had to do. But now it has to grow. They will take a controversial, but I think intelligent first step by building Reko Diq in Pakistan. The market will hate it because it's in a country they can't pronounce, or if they can, don't like. But it's certainly absolutely superb ore body. Newmont, too, has a stated method to deal with the problem. Newmont has suggested that post the Newcrest acquisition, that they will sell every mine in the portfolio that isn't a tier 1 mine. If they do that, that will by itself fix the AISC problem. You do a couple wonderful things there. We're in a wonderful market for juniors to buy projects from majors and lavish the love and care and attention on them that they need. If Newmont does that, they strengthen their balance sheet markedly. But probably more importantly, rather than try and mine or operate 20 projects, they mine 5 or 6. They can focus love, care, and sustaining capital on projects that matter. If Newmont is able to do this, that AISC problem will fix itself. You know, if you look at a mine on a standalone basis, and you look at the return on capital employed over the mine life, maybe it's 20%, 25%. But a big mine, 2 things happen with. First, there are always geological surprises, and they're always good. They were put into production with 10 or 12 years reserve life when in fact there's 30. So that's a good thing. But more importantly, capital expenditures for optimization yield substantially higher returns on capital employed. Somebody who has $5 billion invested in a mine and changes out 4 shovels for $10 million a shovel or 20 haul trucks can often generate 60, 70, or 100% returns on capital employed for that. And that's where AISC comes in. I don't know how long it's going to take Newmont to do that. I hope the amount of time is short. I should say for the record, I'm not a Newmont shareholder. I sold puts, got the stock put to me, and still lost money.
Are you expecting do you think there's a drag on the overall sector because of those two?
Perhaps, but the audience for the sector is so small, I'm not sure how it matters. At the same time that those two have reported dismal numbers, you look at the numbers reported by Wheaton Precious or Agnico Eagle, or in particular Lundin Gold. I mean, Lundin Gold didn't beat the estimates, including mine. They buried them. If you look at even some companies in the penalty box, like Endeavor, that last quarter was a bitch. I mean, so you're seeing really mixed results. I understood that it would take some time for margins to begin to reflect the higher gold price, because certainly last year we had ugly inflation in input costs, and as I say before, we've had to atone for high grading. Everybody has had to atone for high grading. Now you're beginning to separate the wheat from the chaff. There are starting to be companies that have been responsible with their guidance. I don't think that Agnico, as an example, has deliberately underpromised. I think their promises, I know some of the directors well personally. I think their promises reflected their own best guess, but they're operating so well.
I appreciate you sharing on each of these, on each of these items. Rick, I want to turn us over to silver here. Russia announced that they're going to be buying silver to add to their reserves. Do you see other nations doing the same? And if so, with silver having flat supply and fast rising demand, combined with 4 to 5 years of supply deficits, what happens if others, sovereigns jump in to buy silver for their reserves?
Well, that acknowledgement, if it's true, really surprised me. Traditionally, countries buy wealth as a store of value and a medium of exchange. Traditionally, silver has been much more speculative. So theoretically, if Putin follows through, what he really says is, I think the silver price is going to go up, and I'm going to try and benefit my citizenry. That probably isn't the place for a politician. They don't make really good investors over time. I think probably including Mr. Putin. I think he's a spook, a spy, which is not a credit analyst. But at any rate, to answer the question, if you saw more central bank buying of silver, I think you could see a dramatically improved silver price. I still don't understand why they would do it, and I can understand a lot of reasons why they wouldn't do it. But, if one looked for times in history where governments did stupid things, one wouldn't have to look too far or too hard.
Okay. I mean, I'm not throwing this out there really for a big discussion because I do want to get to a few other things, but I mean, maybe they're doing it to secure some stockpile for military, AI, electrification purposes. I don't know. But
you find silver to be fungible, all those things to be fungible. I don't think that there's a need for a strategic stockpile.
So short of, this strategic stockpile issue, what do you see for silver moving forward?
My experience has been that precious metals bull markets, and by the way, I think we're in one, are led by gold. As the price action in gold makes the narrative more popular to a broader audience, particularly to investment generalists, leadership changes from gold to silver. I don't know why that is. Perhaps the lower unit cost. I don't know why. I've wondered it for 50 years. Given that I don't know why it's true, I just know that it's true. And I think if we continue to establish price momentum in gold, that at some point in time, and I can't tell you when it'll be, that leadership will change to silver. And don't worry about it being too subtle. You won't need Rick Rule to tell you why.
Yeah.
When silver begins to outperform, it's pretty dramatic. And I absolutely positively believe it will happen. It's troubled me for 50 years and I don't know why, but I don't.
But I know we know it happens. And
Yep.
I've heard you talk about how the percentage of your portfolio can go from a 2% allocation to 20% worth in one of those bull rallies for silver.
Without me adding capital to it, doing it organically. That's correct. I mean, the numbers, we didn't discuss this, but as dramatic as the upside in silver is, the upside in decent quality silver stocks, in particular the silver juniors, historically has been insane. There just isn't enough market cap in the silo to contain the money that comes in from the generalist investors. And by the way, I don't mean, silver mosquito, silver dragonfly, silver snake. I don't mean the penny dreadfuls whose only silver is in the name on the share certificate. I mean the legitimate juniors. But I look back to the early part of the decade of the 90s. People don't remember, but we had a really, really, really strong upmarket in small resource stocks then. I remember underwriting Silver Standard at 72 cents with a warrant, maybe $1.25 warrant. 6 years later, that was a $40 stock. At the same period in time, we did Pan American Silver at 50 cents. That was a $40 or $45 stock. We did Silver Corp at 35 cents. It was a horrible underperformer. It only went from 35 cents to $15. The upside in these things, I don't know when it'll happen, and we're starting from higher bases now, but it's really difficult to overstate the performance of high quality juniors. I mean, even if you look at this year, we haven't actually been in a silver bull market, but the silver juniors were so oversold at the end of last year that a basket of the decent ones, the Ayas, the Vislas, the Mags, the Silver Crests, that portfolio by itself is probably up 200, 250% in a year without being in a silver bull market.
So I was interviewing Brian London just the other day, and he was referencing that early 90s. He said that he was, in the group talking. Yeah, present. Okay, so I want to move us over to uranium real quick. Rick, Paladin, Kazatomprom, Cameco, and other uranium producers, they've dropped production estimates for 2025. I guess there's no longer a uranium supply deficit because equities seem to be priced like we're in a balanced market now. But Paladin and Fission, they both dropped more than 20% today. What's going on with the uranium miners, and where do you expect them to go in 2025? And what are you expecting for uranium pricing on the whole?
I don't think the uranium price needs to go up. I think it might go up anyway. I think what's important is that uranium is the only commodity in the world that has a term market now. So producers are free of the tyranny of the overnight market, the spot price. Every other commodity in the world, you're a price taker. You take whatever the overnight number is. In uranium, you can lock in price and volume with an investment grade counterparty for as long as 30 years. That price stability lowers the cost of debt capital, and it lowers the cost of equity capital too. It's interesting that the single most important part of the uranium market is something that maybe 1% of investors pay attention to. I guess that's why it's easier to outperform them. Now, the softness that you talk about, I think, is more company specific than uranium specific, although bad news always deflates momentum on a temporary basis. Kazatomprom, two problems. One I don't understand, which is the incredible turnover of management in the middle management levels. Probably politicization at the top, but I don't know. But the second is the underperformance of Inkai, which I hadn't expected. Normally, resuming production at an ISR project is about like operating a waterflood in the oil and gas business. Usually they perform according to expectation, at least over time. And Inkai hasn't. That impacted both Kazatomprom and to a lesser extent Cameco. Cameco has been very forthcoming with regard to the fact that they wouldn't return mothballed projects to production until they had contracted enough volume for a long enough time that their shareholders could earn a reasonable return on capital employed. That will tell me that they haven't yet succeeded in long-term inflation index contracts with an $80 floor price because they have a lot of production which they could return. I'm taking them at their word. Paladin's decline, I think, was due to the fact that they probably materially misstated reserves and resources. They have made a fairly cryptic announcement on the Australian Stock Exchange that refers to some difficulty that they're having with regulators over reporting. Given that fission is subject to a takeover by Paladin, an all-script takeover, in those circumstances, you have to pay attention to the numerator and the denominator. So it makes perfect sense that fission would sell off as a consequence of the fact that the script that people will be receiving for it has come off. So I think in each case, the price action, Lotus too, while we're at it, is more company specific than sector specific.
Are you expecting a snapback in these at some point in the months ahead?
Yes, 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 and yes. I mean, my favorite was Kazatomprom, which I've mostly sold because there are risks around employee turnover that I don't know how to explain. And normally, if I feel that I don't have a good enough grasp on something to own it, I don't own it. So it's gone from my biggest position, let's just say, to no longer being my biggest position. I am, depending on the price movement in fission, I'm more likely than not to become a fairly big buyer. I believe that deposit needs to be built in conjunction with NextGen. I don't know when NextGen will be built, but the idea that you'd have duplicate overhead, duplicate facilities way out there makes no sense to me. And I think if Paladin fell through, that there would likely be another suitor because I think everybody wants to be part of that whole. So I'm obviously attracted to that. I'm attracted to the whole space. Yeah. I really, really am. And I have, oddly for me, because I'm not a trader, traded the space fairly well when there has been too much euphoria, too much momentum in the uranium juniors. I've been a pretty good seller. And when that euphoria has turned to hate, an emotion I'm much more comfortable with, I've been a reasonably good buyer. I would like to own a lot more uranium equities than I do now. And the consequence of that is that I'd like to see them cheaper.
And we might get that opportunity here coming up. So this has been a fantastic conversation. Before we wrap up here and I ask Rick our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews just like this one that we conduct. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Rick as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. It's now time for our Golden Nugget segment. Rick, I just want to discuss a future picture with you real quick. Picture a dinner party, Christmas 2029, with two tables. One table's very happy for what they invested in beginning in 2024, 2025. It helped to give them financial freedom. And one table is really sad what they invested in beginning in 2024, 2025, because it didn't help them. And in fact, it's hurt them in the long run. What do these two tables represent to you in terms of asset classes?
If we're investors, not speculators, if we're investors, the happy table will be invested in the oil and gas seniors. They will participate in the best business in the resource sector. They'll participate in a business that the big thinkers think will be out of business by 2030, but it'll be very much in business. And they will have enjoyed a spectacular dividend yield while they wait for good things to happen. The unhappy table will be invested in long bonds. They will be earning 4.5% in a currency where their purchasing power is declining by 7.5%. In other words, they will have lost 3% a year for 10 years.
Oh, well, I appreciate that picture right there. And Rick, thank you for coming on to Metals and Miners, for being so generous with your time, your analysis, your ideas. It's been awesome to spend the time with you. Would you please share with the viewers any important message you want to leave with those tuning in, where they could learn more about your work, your bank, your symposiums, your teachings, everything you're doing, and how they can connect with you?
Sure. And thank you for the opportunity. Anybody who cares about the way I think about natural resource investing is invited to personalize it. Go to my website, ruleinvestmentmedia.com. Once there, list your natural resource stocks. Please no crypto, please no pot stocks, please no tech stocks, just natural resource stocks. And I'll personally, for free, rank them 1 to 10, 1 being best, 10 being worst. If I have a comment on one of the stocks that I think might be of value, I'll leave a comment with regards to that stock. Once again, ruleinvestmentmedia.com. Rank your picks. Secondly, for any of you who are for any reason unhappy with your current bank, I suspect that's all of you. If, as an example, they don't pay you interest on your checking accounts, if they constrain what goes in your IRA, if you'd like your IRA to own a duplex or a triplex or something like that, or if you're a precious metals holder and you'd like to establish a credit facility, if you'd like the ability to borrow against your precious metals, check out Battle Bank. In fact, if for any reason you're unhappy with your current bank, either visit battlebank.com or at Rule Investment Media in the question and comment section, simply write in bank, and I'll put you in touch with Battle Bank.
Wonderful. Well, I will have all of that information up on the screen during that period of time there. I will also have links in the description area for everyone to click through. Rick, thank you so much for coming back on. It's been a joy to have you, and I look forward to having you back on again sometime soon. Everybody else, thanks for watching.
Thank you.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews just like this one that we conduct. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.